A boom in IPOs, eye-popping growth rates. Southeast Asia was on a roll in 2012, with equity markets like Thailand and the Philippines some of the best performing in the world. But how long can the party last? With money flooding into Asia from easing programs in the West, investors are on the hunt for better bargains. Indonesia, trading at 3.1 times book value, is now the most expensive market in Asia, followed by the Philippines and Thailand. And China, with its resurgent economy, is the new darling of Asia fund flows, with China-focused ETFs drawing almost $5 billion in the last 2 months. Michael Kurtz of Nomura.
It's the major problem, the major headwind for ASEAN equity markets is simply that they are now comparatively expensive and comparatively crowded. ASEAN markets tend to be less externally oriented in terms of the makeup by company or by sector, more domestic orientation, which makes them more defensive in the context of a global slowdown or a trade slowdown.
In October alone, Reuters data shows mutual funds investing across Southeast Asia saw about $500 million in outflows. But there are indications funds are already starting to trickle back, given its proximity to China and its own fast-growing consumer sector. It's unlikely Southeast Asia will fade into the background. Wealthy businessmen in Thailand are driving a fresh wave of M&A activity. Companies and tourists are flooding into emerging Myanmar. It and the region's manufacturers are set to gain as Chinese labor costs march higher. Some analysts are still betting on the region's consumers, overweight on sectors like Malaysia's telcos or Thailand's banks. The wild investment ride into Southeast Asia may take a breather, but in 2013, many will still find the region a land of sky-high opportunity.